Good afternoon, participants.
Good afternoon, ma'am.
Welcome to the last session of day 1 FGP. We'll just start in another 2 minutes. For those who have missed the attendance link, I have reshared it in the chat box. Please do the needful. Rekha ma'am, hope you have got the link of the attendance form.
Yes, ma'am.
Yeah, this is the link for the feedback form of the previous session by Dr. Sujit Maitre. If you have missed it, you can fill it.
Ma'am, I have attended both the sessions, sir. So
Yes,
this
ma'am.
session I marked the attendance, but for the previous session I didn't mark the attendance.
Okay, I'll take care of that, ma'am. Don't worry. I'll note it down.
So thank you, ma'am.
Yeah. Any participant has any query or doubt? We'll just start in another 2 minutes by the time everyone joins in. Pranay sir, shall we start?
Yes, we can.
Okay. So welcome to the last session of day one. And on behalf of the Tata Megi Institute of Management Studies, I, Dr. Hetal Gaglani, the Chief Coordinator for this FTP, welcome our expert speaker, Dr. Pranay Parashar.
Thank you.
I hope the PPT is visible, yes. Dr. Pranay Parashar is working as an assistant professor with Department of Commerce and Financial Studies, Central University of Jharkhand, Ranchi. He has completed his MBA in Finance and MCOM in Finance. He has also completed NET exam in Commerce and SET in Management. He has a total rich experience of 18 years. 13 years he is into academics, and for the past 5 years, and previous experience was 5 years in banking and financial service industry. He started his journey with SBI Mutual Funds, and then he got associated with Arya Chanakya Consultants Private Limited. In 2009, he joined academics with DIMSR Nagpur, then worked with Symbiosis Center for Management Studies Nagpur. He is also a UGC fellow at SGB Amravati University, Department of Business Management, India. Apart from this, he is also a trainer for NCFM, mutual funds, fixed deposit, and financial derivatives. So with this, I welcome you, sir, on board. And I would request, before starting the session, I would request all the participants to please pay attention to your mic. And if you have any queries or any doubts, you are free to unmute your mic. But apart from that, please ensure that your mics are on mute mode. We'll have this session till 5:15. And the attendance link and the feedback link will be shared before 10 minutes, before 15 minutes. So at 5 p.m., the link will be shared. Over to you, Pranay, sir.
Okay, thank you. Thank you so much. If I can have a few questions answered. I hope all of you have got the Excel sheet earlier.
Yes, sir.
Great. I will like to have this in a more of an interactive manner. Accounting, we have experienced that it's not appreciated by especially non-finance students. So I'm taking all of you as respected faculty members and hoping to learn with you, as all of us can say help each other learn together accounting in a better, more lucid manner, I would say. So it's easy for us, at the same time entertaining for us. And finally, we should be able to make some sense and relate this theory of accounting with the actual real world. Okay, that is my intention today. So the topic that was given was understanding accounting better. That was the theme. So I'll just share my screen. I hope it's visible.
Yes, sir, it's visible.
Right.
Sir.
Can I go on the slideshow mode, or is it okay like this?
It's okay like this as well, sir. No issues.
Just to be comfortable. There would be slides wherein there's more text, so I want that to be readable.
Okay.
Is it visible now?
Yes, ma'am. Yes, sir.
Great. Fine. So accounting terminologies. I have been actually listening to the first two sessions, and because I was there and I was hoping let me understand, and I was trying not to be repetitive, not to sound repetitive. So I was there, and I'll try and answer a few questions which I have heard, especially in the previous session, Dr. Sujit Maitre's session. That is also something which I have in mind. So let's start and understand accounting in a convenient way. Let's proceed. So we have this basic model, fundamental accounting model, which says assets are equal to liabilities plus owner's equity. I guess at this point of time, we understand what assets are, what liabilities are, and to some extent, we do understand what owner's equities are, right? So this is the basic formula. All accounting works around this basic formula, and this is why we have financial statements and income statements to follow, which we read and interpret to make more sense of finance. So with that background, uh, let's focus a little more on the owner's equity part of it. So we know that owner's equity is something which increases by investments and revenue. So as your investments increase, so does your owner's equity, because it's more of a linked thing which will happen side by side. And then there would be revenues. If you are able to earn more, that will again go and add up to the owner's equity again. So if these two increase, your owner's equity would actually increase, and if they decrease, your owner's equity would decrease. On the other side, we have withdrawals and expenses. So as we take out money from the business, that is what we mean by withdrawals. So we call drawings, if that is what most of us understand with the accounting background. So if the promoters of the business, those who had actually started the business, they take money out of the business, that is where the owner's equity would come down. And if there are more expenses, again, once again, the owner's equity would come down, because more expenses would mean less profits. And if there are less profits, a smaller part goes into the owner's basket. So that's how these are related. Please let me know if I am audible enough, or should I need to, do I need to raise my voice?
So you're audible clearly.
Great, great. Thank you. So that was about the basic accounting model about accounting. Let's proceed further. So I have this situation wherein on issue of equity shares, a business receives rupees 9 lakh. It's a business case. Say somebody is starting a business,
Pranay,
and
sorry to interrupt you. Please change your slide. It's the first slide only.
I did change. It's not changing there.
No, it's not changing here, sir.
Okay. Is
Yeah,
it
now
okay?
it, yes. Now there is an illustration over here.
Fine, fine. Okay. So we'll work with this mode only. So we have a situation wherein on issue of equity shares, the business receives rupees 9 lakh. It's a normal process. You would have heard about IPOs in the market. Talking about the calendar year 2021, we had around 66 IPOs in the whole year, if you can think of it, almost an IPO every week. So what is an IPO? An IPO is an initial public offer wherein people like you and me get an opportunity to buy into somebody else's business, right? So you subscribe equity of a company. So that is the case here. Say for example, a company is selling shares, and on account of the same, the company gets rupees 9 lakh. So just by the statement, if you look at it, on issue of equity shares, the business receives rupees 9 lakh. From an accounting perspective, there are basically two things which is happening. One is on the asset side, and the other is on the owner's equity side. If you can look at my cursor here, this is the asset side. I would say this is the left hand side of the of this equation. So asset side has got increased by rupees 9 lakh because 9 lakh comes into the business. And on the right hand side of the equation, you have two components, liabilities and owner's equity. So owner's equity part gets affected because you actually sold out equity. So you have equity capital rising by rupees 9 lakhs. So think of it. I would invite somebody, if anybody from the participants can come in and tell me, say for example, somebody buys a sofa for their house, and what would be the two impacts? Anybody?
Yes, so sofa, if when you're buying a sofa, it gets added, the whatever the cost of sofa is it gets added to the asset side because it is
Okay.
an asset, right?
Okay.
Yes, and from
That is one side of it. The other side?
the other side is liability side.
Okay. I basically kind of just wanted to capture how the audience is reacting. So thank you for your answer. Can I, Mr. Binay, I believe that was your name?
Yes, yes, correct, correct.
Right, Mr. Binay. This was a little, I would say, for a beginner session, a little difficult question to answer because in this thing, what happened was definitely so far as an asset, it came in, but what went out was cash again. So both these transactions were on the left hand side itself, both nullifying each other on the left hand side itself. Cash reduced to the extent of the cost of SOFA, and SOFA came in again. That's an asset. So
Yeah.
that is what my second example is. Yes, Ms. Varsha, you want to say something?
No, sir, no, sir.
Okay. So this is a situation where you purchase a building, say for rupees 6 lakh rupees. Now what happens is cash goes out from you. So you are deficit of rupees 6 lakhs, and building is what you have now in your possession, which is valuing worth rupees 6 lakh. So no transactions on the right hand side. As you can see, no liability change, no change in owner's equity, but it was only assets which got affected on both counts, right? So this is what we call the dual effect. So each financial transaction, and you will find that there are two possible effects which we capture in accounting, and we call it the dual effect. I'll come to the technicalities of it a little further. The dual effect of each transaction is recorded separately, and thus the integrity of the accounting model is maintained. Uh, I could have had more examples, but I thought it's now the third session, so I would like to wrap it up as soon as possible, and I will jump to the balance sheet and the other financial statements, which I've already circulated with you, and try and give you more examples there itself. Now, what happens is you can imagine how many of us are all my participants. How many of us are maintaining the household budgets? How many of us record that? If you can say, do we have any system of capturing audience response, participant response? Hetal, are you there?
Yes, sir, I'm there. So they'll be answering in the chat box.
Okay. So if you can just write yes or no, simply Y and N will suffice. If you can write that, I can see the chat box now. So I have 2 yeses, a few no's. Okay. 3, 4 yeses. Fine. Very nice. Very nice. So some of us don't record simply because we find it to be a little too tedious, possibly, and that is the reason why we don't do it. And some of us do record. My question to those who actually do record, what kind of problems do you face while recording these transactions, or there is no problem whatsoever?
Many times we skipped the expenses that we have made, maybe the petty expenses.
Yes, many times we skip that, correct? Very petty expenses, we skip that, okay. So if such a situation happens, and most of us don't do just for the sake of the consistency that is required, the discipline that is required in maintaining these records. So most of us don't record all together. Yes, cash transactions or small transactions are not in the record. Correct. So think of a business which is actually into this thing of recording, and people asking them as to tell me how much money you spend there, how much money you have earned from there, and so on and so forth. So it is quite possible that the magnanimity of the scale of the say entries which would be there, that the number of transactions that would be required to be recorded is so huge that it might be difficult to keep track of what are assets, what are liabilities, what are equities, and say be able to give actual right numbers to each of these. The second thing is obviously error is very eminent. It can happen because because of the sheer number of transactions which are there to be recorded on large and small transactions. Everything needs to be recorded, right? So these two are the basic structural problems which are there with accounting, but then we definitely have a way of doing it, and therefore let's see how we go about handling these issues. So to cope with these problems, we require what? An efficient method for keeping track of each kind of asset, liability, and owner's equity. I guess all of us have seen the old movies. I remember Mother India, one of the great Indian movies that if you could, and we had that Munshi Ji, if you can remember. Yes, no, or Munim Ji, if you can recall,
Yes, sir.
right? So they have a huge Bahi Khata with them. It's a long register, and the zamindar, the landlord, the local landlord, he calls up Munim Ji, tell me how much this person owes me, and he would simply flip a few pages and then tell me count and then give you a number, right? So how is that being possible? Matlab, there would be so many different villagers who would owe money to the landlord, to the local landlord, but that Munimji is so perfect in his calculation, he's able to give it to you. Why? Because there is a system, there's a system of classification, right? And this system of classification has got two strong features. One is called having separate accounts. We will be having separate accounts for each of these. So each of the borrowers for that particular landlord will have a separate page dedicated to him, because on few days he would come in and pay back, on few days he will come in and borrow more. So everything has to be recorded in one single place, and you cannot give somebody else's credit to somebody else and vice versa. So you have to have accounts, dedicated accounts, and imagine the different things, right? The Excel sheet that I have shared with you, it has got so many different entries, and these are just aggregates. If you go into the details of it, you will find so many different more. So just for example, if we are talking about trade payables or trade receivables, that's an item there, right? But there are so many different people from whom you are yet to receive money. So if you are talking about somebody like HUL, say for example, so HUL sells detergent powders, right? Say for example, so HUL is selling detergent powder, and it is being sold pan India. Pan India, there would be so many shops buying from HUL and then paying back to HUL. Somebody, as the last session had that example of, you take it now and then you can pay me back later. So the company needs to keep those records, right? It would run into so many different pages, so many multiple pages, but then that is essential, because you cannot say demand more than what somebody owes you, and at the same time you don't want to pay somebody more than his due credit, so you need to have separate accounts. So account is something which is critical, and the next and important thing is the system of debits and credits. Everybody is with me here? Okay, speed okay, sound okay, yes, no?
Yes, sir.
Okay, great. So we are going to understand these two little in a pictorial manner, and let's see how. So the first part, as I said, was the account. What is an account? An account represents a standardized arrangement for recording data. It is like in your, say, most of us are teachers here. So I teach in semester 1 and semester 3, say for example, at any given point of time. And semester 1, I have got a class of, say for example, 60 students. In semester 3 also, I've got a class of 60 students. Uh, I need to have separate records for each of these students as to how they have been performing. Their mark sheet that the control of examination will be issuing will have his own records, and not the roll number 1's marks go into roll number 5 and roll number 5's marks goes into roll number 10. So to keep that separate, we need to have accounts. So accounts, I guess now everybody's understanding what an account is. So it's just a dedicated, I would say, record for one single entity. It could be a single asset, it could be a single liability item, or it could be single expense or income. One single account for each separately. Is that clear? Yes, no? People, ma'am. People, I guess your mic is switched on. Would you please switch that off? Sheetal?
So you have the power. You are the host actually, so you will be able to do it. Sheetal ma'am.
How do I do that?
Sheetal. Sir, जहाँ पे आपको mic दिख रहा है, just click on that, and you're there. You will see more. Click on Sheetal. Sheetal Mamgain.
I can see my mic.
Just hold on, sir. Sheetal ma'am. Sheetal ma'am, please mute your mic. So can you see Sheetal name?
Let me try.
It will be on the top. It will be on the top.
This is,
Yeah,
okay.
yeah, she has muted her mic.
I did that. Thank you.
Okay.
Fine, fair enough. So be it any asset, liability item, income item, expense item, you need a separate account for each of those. And that's how they actually function. That's what an account actually means. So in a typical accounting system, there exists a separate account for each. Say for assets, you have got land account, building account, equipment account, inventory account, cash account. Similarly, for liabilities, you would have trade payables account, bank overdrafts account. In owner's equity, you will have a share capital account and a general reserve account. Likewise, so you have different accounts for each of these. Let me go ahead. Okay, so this is what I actually mean by a traditional account, right? So as you can see, there are 8 columns: date, particulars, JF amount, and then again date, particulars, JF amount. You might wonder as to why this is being repeated. So basically, we have got two parts of it. So date, particular, JF amount on the left, and then again date, particular, JF amount on the right. Okay, so these are the two sides of it. The left side is typically the debit side, and the right side is typically the credit side for accounting purposes. And every account will have this system of representation. Okay, yes, no. Can I have a few answers, please? Yes or no?
Yes, sir.
Okay, thank you, Shrutika. Let's proceed here. The next is the system of debit and credit, right? So it's okay. Now what we can do with the moment we have an account, what the objective is that we can have separate I would say sheets, बोल सकते हैं. We actually call these as ledgers. These are separate ledgers for each of the different parties, you may say, the asset party or the liability party or the income or the expense party. That's how you classify it. Anybody can answer. I believe finance people can answer. What is this JF and what is it? What does it stand for?
Journal folio.
Very nice. Thank you. So journal folio is a system wherein you basically record the transaction at an early level and then you transfer that journal entry into the ledger posting. So it's kind of a double check again. All ledgers would be preceded by a journal. So you refer that journal page. It's folio is a page and journal is a book where you enter the records. So each account will have a specific page from where to enter or record transactions. Okay, let's proceed. The system of debit and credit, if you can pay attention and make some sense out of this, I would like you to interpret this for me. Say on the asset side, this is a plus, this is a minus, this is a debit and a credit. And on the liability side, it is just the reverse. Negative is debit and positive is credit. So can anybody interpret this much for me? What do we mean by this? What are we trying to say here?
Sir, here assets, debit of assets means whenever assets are increased, they are debited. And whenever assets are decreased, they are credited.
Great, sir. Thank you so much, Mr. Sanjeev Thakur. Thank you so much. So as there is an increase in assets, the same gets debited. And as there is a decrease in assets, the same gets credited. And the liabilities are exactly the opposite of it. As there is a increase in liability, it is credited. And as there is a fall or decrease in liability, it is debited. The same rule applies to the owner's equity also. And therefore, you would find that as a result, all debits are always equal to credits in all transactions, and therefore also assets are equal to liabilities plus owner's equity. Is that clear with everybody? Yes, no?
Yes, sir.
Yes, sir.
Thank you.
Yes.
Thank you. So a quick revision here. In double entry bookkeeping system, every transaction is noted twice. That is at two different accounts at two different sites, but with equal amount. So we can say that for every debit, there is a corresponding credit. Every transaction has two effects, just as there are two parties to every transaction. For example, buyer and seller, receiver and giver, debtor and creditor. Any questions here? I have used the word debtor and creditor for the first time. Debtor, do we understand what do we mean by debtors? Unpaid customers. Okay, thank you, Mr. Ghai. So these are debtors are those customers of ours who have bought goods from us, but they have not really made the final payment yet. And to the amount of the outstanding payment that is due for us to receive, the person is the debtor. And the exact opposite is the creditor. The person from whom we have bought, but we haven't made the payment, is a creditor for us. Thank you. Thank you. Assets, debtors, and expenses always show a debit balance. These would typically have debit balances. Liabilities, creditors, and incomes would always show a credit balance. What do we mean by a debit balance and a credit balance? Anybody?
Hello, sir, I am audible.
Yes, yes, you are audible.
The debit balance show the all expenditures, and losses, and credit balance show the all the incomes and profits. This is the types of account related to the nominal account.
Right, great, fine. Okay, okay, okay. Thank you. Anybody else? Fine. What I want you to understand here is I would like to go a little back and look at this account. Say, for example, what should actually happen is these accounts at the end of the financial year would typically be closed, meaning the debit side should ideally be matching credit side. But that is not always the case. There is always something which is left unbalanced. That which is left unbalanced is what I mean by a debit balance. If the balance is on the debit side, unbalanced amount is on the debit side, and if it is on the other side, that the right hand side, we'll call it the credit balance. When total of credit exceeds, it means credit balance. Absolutely right, Monica Kataria ma'am. Thank you so much. And similarly, when the total of debit exceeds, it will call it the debit balance. So that is what I was trying to explain here. And most assets, as the slide said, assets, debtors, and expenses, they would have a debit balance. Liabilities, creditors, and incomes would always have a credit balance. Okay, balance BD comes in credit side. Let us not jargonize the discussion. When you say balance BD comes in credit side, that would kind of for non-finance people, it would kind of be a switch off mode because they won't be able to understand that. Fine, then let's proceed that. So when the total of debit side is more than the credit side of account, then that balance is called as debit balance, and the exact reverse is the credit balance. I'm moving on so that we can touch upon the balance sheet, which I've already circulated. This is the information processing cycle that is normally there. So where does the accounting process actually start? So we start with the collection of raw data as to what actually happened. Fine. So you paid some expense, you got some payment, you bought some raw material, whatever be it. So that is the basic raw data. At the next level, you analyze those transactions, meaning whether it is going to impact your assets or liabilities, or it is a routine expenditure, or it is a capital expenditure. We'll try and understand those as well. But that is what it actually means by you analyze it. Where is it going to be recorded? Which book, which journal, where? Then you pass the journal entries, that is called the journalizing the transactions. Once the journal entries are done, you transfer the same to the ledgers, that is called ledger posting. So here is where the accounts get impacted. Once these are finished, the financial period is over, you prepare a trial balance for the same. Then finally you have some adjustment entries because you realize you had sold to somebody who actually did not pay up, and that needs to be classified as bad debt which did not turn up good. So they need to be adjusted for. And finally you have preparation of financial statements. So you prepare your income statement, your balance sheet, statement of equity, and your cash flow statement. So this is the process of accounting. We are primarily concerned with analyzing financial statements for the day. That is the theme. So we'll talk about it a little more today. Let's proceed. Assets are predominantly of two categories, non-current assets and current assets. Any other name for non-current assets? Anybody?
Short-term obligations.
Non-current assets.
Fixed in nature, like building, machinery.
Building, machinery, yes. Thank you, Varshana. Anybody else?
Intangible asset.
Intangible assets. Okay, intangibles could be there, right? Very right. Okay, what else? How do we differentiate between the two? What parameters should we have?
Non-current assets are the assets which can be used for more than one accounting period.
Great, good definition. Current assets.
The assets which we convert into monetary or money figure instant, like
Within a short span of time, I would say, right? Within the financial year, if you can say that. Yes or no?
If they won't share, because classes will be till 5 o'clock, no?
Sushma ma'am.
Sushma ma'am.
5 o'clock.
Sushma ma'am, please mute your mic.
I have muted her. Okay. Fine. So that is how most of us have given good definition. What I say is there could be instances where your fixed asset would be recorded as a part of your current asset. Is that a possibility? Anybody? Where your fixed asset would be recorded as a current asset. Is that a possibility?
If it is brought in the same financial year?
If it is bought in the same financial year. So you mean to say if I buy an equipment for the next 10 years, in the year in which I buy, I can record it in the current assets. Is that so?
Yes, sir.
No, it's not the case. You don't do that. But I think you need to think a little bit more, I guess, and you will be able to get the answer there. In the last session, we were discussing about depreciation. Yes, no? Charging more, charging less. Am I right?
Yes, sir.
Right. Okay, great. So you depreciate assets. Why do you depreciate assets? To start with, why do we depreciate?
Because due to normal wear and tear, they get old, or there is some new technology due to which they get degraded.
They get degraded.
So
Okay.
that we can make a provision for purchasing it after a few years.
Fantastic. Yes, we need to make a provision to replace it after a few years, right? Very well said. Most importantly, it's a tax deductible expense and it helps me save on my taxes, and therefore I do it. That's the primary reason why do I depreciate my assets. I can always have a separate reserve. If I want to buy a new one, I can always have a separate reserve. But the good thing with companies is for them it's a tax deductible asset. So they buy a sofa, they can depreciate it for over a 10-year life, and then after the 10 years, they can possibly buy a new one. Unlike us households who really cannot do that, right? Let's stick to that example wherein you bought a sofa and you are going to depreciate it for the next 10 years. Think of the 10th year in which you are actually going to write it off completely. In that very year, can you consider that sofa to be a current asset? Yes, no.
No,
Why no?
its value has become zero.
It's about to become zero. It's about to become zero, not exactly zero. You're going to scrap it definitely, and you will get something out of it. So you are going to write it off completely. But in that very year, till the time you haven't yet really scrapped it, you can record it as a current asset, yes or no. So that is where the beauty comes in. Most of us do understand that yes, building is a fixed asset, inventories is a current asset, and we understand that totally fine, absolutely right. But then when a fixed asset is going to say to be replaced, the year in which it is going to be replaced, in that very year, it could be recorded as a current asset because it is going to convert into cash or it is going to cease to exist. And that is where you record it as a current asset. Where pretty much like liabilities will come to the balance sheet, which I've already shared, and we'll take a similar example on the liability side of it and we'll discuss it there more. Okay. On the liability side, again, we have got non-current liabilities and current liabilities. Before we proceed, I had this question here. What should be more? Assets may, which one should be more in our balance sheet? We should have more of non-current assets or we should have more of current assets? What should be more?
Non-current assets.
There should be more. Why?
Means if it's a long-term investment, then slowly it's going to. Means when we have long-term investments, will it be going for non-current assets?
You are talking from a business perspective, I hope. Yes, no.
Yes.
So non-current assets, if we have more of non-current assets, say for example, our balance total assets is 100 rupees, what you are trying to tell me is we'll have 60 of long-term assets, non-current assets, and 40 of current assets. Yes?
Sir, maybe it depends on the kind of business, which kind of business you are doing. Like maybe some business opt current assets more than non-current assets and some are vice versa.
Sir, can you give examples?
Can
you give examples of non-current assets and current assets?
Non-current assets are building, furniture, machinery, equipments. These are all non-current assets, which you hold on to for more than one financial year as was earlier defined. Whereas current assets, where you have got inventories, trade receivables, cash, bank balance, all these are current assets.
Is it that at the start of any business, means when an investment is done, non-current assets will be because we are putting it in equipments and machineries and building, and then as the business years pass on.
Yes. As the years pass on,
current assets will then non-current assets value will keep on decreasing. Actually, sir, I am not from accounts, so
that's
sure.
perfectly fine. I don't want you to give right answers. I just want to try to answer. That's it. That's what I want.
So I believe that the value of current assets should be more because it gives more liquidity to the company, I mean the organization, and therefore they can finance their working capital in much better way. So I think current assets should be more than the non-current ones.
See, most of these answers are correct, but the best one is it will actually depend on the nature of the business, right? Say if you are talking about restaurant kind of a business, right, or any service-oriented business, say for that matter, they should typically have more of current assets and less of fixed assets. as compared to the traditional businesses like a steel company or a power generating company or a pharmaceutical company. They would have more of non-current assets because the nature of the business is so, right? So there's no straight answer as to what should be really more. It will basically depend on the nature of the business. And then again, there are other affiliated areas, as you rightly said, key. Given a choice, the company should be having more of liquidity because that makes them more flexible to operate. That is okay, much appreciated. But then the structure of the business might not give that kind of flexibility to old businesses like steel, cement, automobile, cement, and the likes. Whereas the other service-oriented businesses would typically have more of current assets as compared to non-current assets. I hope you have got me there. Is it okay? Yes, no?
Yes, sir.
Yes,
Okay. Okay.
Yes, sir.
Let's talk about liabilities here, non-current liabilities and current liabilities. I guess by now you understand what do we exactly mean by this. Non-current liabilities would be long-term loans that I have, right? I have a term loan with a bank that would classify as a non-current liability. I have sold debentures, maybe that would be classified as a non-current liability. And current liabilities are trade payables. I need to pay my vendors in the short term. I need to clear my bank overdraft, which I have with my bank. So they would classify as a current liability. The question this time around is what should be less? Non-current
liabilities.
Non-current liability should be less. That would basically mean
Long-term borrowings to a company, and it directly impact on your balance sheet.
how would that impact?
Your liability side, like creditors or loans, particular debt section will impact.
You will have
I'll
debt.
add on to it.
It increases your liabilities in long-term liabilities.
It increases your liabilities, long-term liabilities. Yes, I agree to it. It increases your liabilities. But between the two, which should be less? That is the question here.
Non-current liabilities, because you have to pay certain amount in term of interest, in term
Right. Let me finish this and then I'll take the gentleman's point who wanted to add something. Say, for example, you have a bank loan, and that is what you actually want to mean when you say non-current liabilities. So you have a bank loan at the rate of 10%. Fair enough. So you have a bank loan at the rate of 10%, wherein your business is earning, say, for example, 15% ROI, return on investment. Hello?
Yes, sir.
Vashaman. Yeah. So you are earning a 15% ROI on your total investment, of which bank loan is also a small part. And there you need to repay to the bank 10% rate of interest. Is it really bad here? Are you much worried about that when you are earning 15%?
No,
There's no need to worry, right?
I think there is a cause of worry because my effective rate of earnings will be only 5%. And
Right.
as a matter of fact, if I use these funds and put that in the FD, that'll pay me more return than doing a business. So from the promoters or the owner's point of view, I think it's a bad idea to have this kind of situation of having 10% loan and 15% ROE.
See what happens is, say, for example, 100 rupees. I'm taking, say, simple round figures. You have 100 rupees, and out of this 100 rupees, you have got 60 of your own equity and 40 is the debt capital. Is that okay? Yes, no? Yes, no? You have 100 rupees in all. Out of 100, 60 is equity and 40 is the borrowed bank wala 10% rate of interest wala loan amount. Okay, na? Okay. Now you are making 15% on the whole 100. So your total return is 15 rupees.
15
right? 15 rupees may your 9 rupees is there itself.
Right.
15 ka 9 is for the equity wala because they had put in their investment 60 rupees and they get 9 rupees out of there. So they are earning 15% return on their own investment. But the bank wala paisa, that 40 rupees which has come from the bank, that is also earning 15%, right?
Yes, sir.
Yes or no?
Yes.
So you earn 6 rupees out of their 40, 15% of 40, you earn 6 rupees there, and you give to the bank 4 rupees because 10% of 40 is 4 only. Yes or no? So you
Yes.
save 2 rupees, yes or no?
Yes, sir.
And who enjoys this 2 rupees? This is
Owner.
the equity wale investors, they enjoy this. It is their capital which is actually going up. Right? Siddharth?
Yeah, I heard you. I mean, I'm still figuring it out that what you have just said. I think that you're talking about the leverage over here.
Exactly, exactly,
Right. So
exactly.
leverage do help the companies, but from the investor's perspective, when I invest in any company, buy the shares of any company, I choose the company whose debt are relatively very low, so that their profit margins doesn't get impacted by the interest payment.
Yes, that is a concern. I appreciate that, but I'm not going to that extent at this
Right. All right.
point of time. That is definitely a concern, and I appreciate that. But just for the sake of this, as to which should be less, non-current liabilities or current liabilities. See, a company is able to raise debt. It means that the company is fundamentally quite strong, right? You look at the banking structure that India has. Do you think it is very easy to raise funds from say SBI? You go and ask for funds and see the tantrum that they play out to you. But they will be more than happy to give you when you are really, really strong. So if a Reliance goes in or a Tata goes in and asks for fund, nobody really bothers a lot to be lending to these companies, right? Am I making my point?
Yeah, definitely.
Right. So a situation wherein, on the other hand, if you have more of current liabilities, what actually it means is you need to pay more at this point of time. Matlab you have a very short tenure with you, which is available to make these payments, which are quite really very, very huge. So that is something which you don't really want to happen with your business, correct?
Right.
Right.
That is why I think the more current assets will help over here.
Yes, exactly. Okay, so keep thinking with toying with these ideas. I think I have make a dent out there wherein I've been able to touch upon your hearts and minds. Keep thinking and keep coming up. Thank you. Let's proceed here. Okay. So a quick understanding on the different kinds of expenses and revenues that we have. We categorize in accounting expenses in three categories: capital expenditure, deferred revenue expenditure, and revenue expenditure. On one extreme, it is the capital expenditure. So when you buy a machine, when you buy land, when you buy a building, so what you are doing is you are investing a big chunk of your money at one go, right? And this is going to be there for a very, very long term. So this investment is not for 5 days, 10 days, or a year. It's going to be there. The building, the land, the machinery is going to stay there with you for 5, 10, 15, 20 years. And that is what we mean by capital expenditure. The other extreme is the revenue expenditure, the salaries you pay, the telephone bills that you pay, the printing expenses that you have, and so on, so many different wages and materials. All this is a routine expenditure which you keep incurring day in, day out in your business. They are the other extreme of expenditure, and that's what we call as revenue expenditure. So on one side you have got capital, the other side is revenue. Something which is not purely capital, not purely revenue, is called the deferred revenue expenditure. So we can say advertising is an example which is a good example of a revenue expenditure, generally speaking. But then think of, I always give this example, Ban Phool Tel, I believe. Amitabh Bachchan is the brand ambassador, right? Yes, no? Dabur Lal Tel or Ban Phool Tel. I guess it's a Ban Phool Tel. Champi Curry and things like that. Do we recall that?
Yes, sir.
Right. So when Amitabh Bachchan does advertising for something like that, and we know, or at least we have some idea about the kind of money that he would be charging, a small brand like Ban Phool might not be able to take the whole amount into its expenditure in the year of incurring that expenditure, right? So what they do is they have done this ad with Amitabh Bachchan. So they have got this brand recall. Now they're going to run this ad for say for next 3-5 years. So they will say categorize or distribute this expenditure of advertising over a period of 5 years because they're going to get the benefits, yes, but they cannot afford to take the whole thing into their balance sheet, into their income statement in the very year of incurring that expenditure. So those expenditures are classified as deferred revenue expenditures. Have you got my point? Yes, no, everybody?
Yes, sir.
Yes.
Sir, can you please repeat once again?
Yeah, sure. I am talking of expenses wherein it is not practically feasible for the company incurring those expenses to absorb the whole of it in the year in which they were incurred. And I am giving the example of advertising expenses. So you do an ad with, say, the great Amitabh Bachchan, and you end up paying a hefty amount of money to him, but the same expenditure will be recovered, I would say, over a period of 3-4 years. So you scatter the whole expenditure over a period of 4 years, saying that I'm going to run this ad for the next 3-4 years and be benefited from the same again. And that way, your income statement is not hugely impacted, and you are able to absorb it in a gradual manner. That is the purpose of a deferred revenue expenditure. Clear?
Yes, sir. Thank you, sir. Thank you, sir.
Yeah, thank you. Okay. On the revenue side, we have capital income and recurring income, pretty much like capital expenditure. The opposite is capital income. So you sell off a part of the land, maybe, or some big asset is being sold out. You don't sell every day. So that is the capital income. And on the other side, things in which you deal, the goods in which you deal, and you sell it on a regular basis, they would classify as your recurring income. The interest that you earn on your fixed deposits or the investments that companies make, that would be classified as recurring incomes. Okay. We are now coming to the financial statements, and I'll tell you the L&T balance sheet, which I've actually converted for you and given it to you in a single simple spreadsheet, is actually running into 580 pages. Right, the whole annual report is of 580 pages with numerous contexts and explanations and descriptions and so many things. So nobody really takes out the pain of doing everything, but we as number crunchers, we are basically focused on the financial statements per se, and we restrict there. In that context, the whole 580-page report has got two financial statements. One is the standalone financial statement, and the other one is the consolidated financial statement. Anybody can differentiate between the two? How do we differentiate between the two? What is the standalone and what is the consolidated?
One is the one where all the companies, including the subsidiaries, are accounted for. The other one is only the main company, the parent company is accounted for.
And which is which?
L&T, Larsen and Toubro.
Yeah, I got that. So the consolidated is the one wherein everybody along with the subsidiaries are accounted for.
Yes,
This, right. Very well said. Thank you, Mr. Ramesh. I believe it's Mr. Ramesh,
yes,
right? Yeah.
Yes, sir.
Thank you, Mr. Ramesh. So precisely that's how things are. So what I've written here is a mature company can be expected to have several subsidiary companies and associated companies. L&T is one of those mature companies. They have got several subsidiaries. So if you really want to make a detailed understanding of what is the actual income for the group as a whole, L&T as a group, you should be focusing on consolidated statements and not the standalone, where you don't get to really understand what the other associates and the subsidiaries are doing and contributing to the parent company, L&T. So what I have shared with you is the summation of the consolidated reports and not the standalone one. Any questions here? Should I proceed?
Yes, sir.
Okay. It's kind of slow. Okay, so this is the broad structure. We have got the asset side, and then we have got the equity and liability side. Earlier in schools, when we were learning, we were told that there's a left and the right hand side, but now things have changed. It's pretty much a vertical setup that we have, one below the other. So first we have the assets, and it is followed by the equities and the liability side. That is the balance sheet per se. And within that, we have got non-current assets in the asset category, and then we have the current assets. And within equities and liabilities, first we have the equities, then the non-current liabilities, and finally we have the current liabilities. So this is the calculation part is still here. Contingent liabilities is something which the company is expecting that it might arise, and there is a possibility that it might not arise altogether. So maybe there's an impending court case going on wherein you are required to pay, or there were some disputes wherein you are required to pay something. If you lose, obviously then there's no payment required. So those are contingent liabilities. You just because as a stakeholder, everybody needs to know. So you record that in your balance sheet, but that's not really accounted for. So it's not counted in the total figures. Similarly, other commitments that you have made to other subsidiaries, associated companies, or other projects maybe. And finally, you have got the notes forming part of the financial statements, which are separate set of documents. We'll come to them all one by one. So I think I'll now shift to the Excel sheet. All of you are ready with it? Yes, no?
Sir, one question is there, sir.
Yes, Rameshji.
What is the meaning of a deferred tax expenditure?
Deferred tax expenditure. I'll come to it in just a small while.
No problem. Thank you, sir.
I'll come to it. I have that in the.
Okay, sir. Okay, sir.
It's very much a part of the balance sheet, and so we'll talk about it there. Either we stop and then go to the Excel sheet, or we simply share what we want to share. Is the Excel sheet visible now?
Yes, sir.
Okay, great. Fine. So before this, I'll actually show how it actually looks, because I guess most of us have never seen a real balance sheet. How does it look like? This is a PDF. I guess it is visible. Yes, no?
Yes, sir.
Right. So if you can see, we are at page 441. It's basically a 580-page document. All of us can see that?
Yes, sir.
Right. And this is where the consolidated balance sheet starts. And this is actually the whole thing. So we've got equity, liabilities, and this is as at March 31. If you can pay attention here, balance sheet is as on a particular date. So this is as at March 31. Whereas when you go to, say, for example, an income statement, you will realize profit and loss for the year. So you have the profit and loss for the whole year as to what actually was incurred throughout the year. That is recorded here. Whereas a balance sheet is as on a particular date. Clear? Yes, no?
Yes, sir.
Right. Similarly, as on this date, so that date, that column will be held first, and then you have the previous year's data as well. So at least one single annual report will give you 2 years data, and you can make some inferences, not too substantial, but then some basic inferences like property, plant, and equipment. The figure was around 11,000 crores for the year 31st March 2021. The same for the previous year was 10,100 crores. So you would say that almost 1,200 crores, say the property, plant, and equipment have gone up. So maybe there were new purchases made, or the valuation went up, whichever way. To find out what really happened, you need to go to the notes, and this is the column where note number 2 will have more details on property, plant, and equipment. Are you understanding how to read a balance sheet? Yes, no?
Yes, sir.
Right. So notes basically follow later. So as we scroll down, we'll find the notes being there, and that is for each item you have a separate note, which will be a more detailed information on the given heading. So property, plant and equipment, we all understand. Let's understand what is the meaning of capital work in progress. What is a capital work in progress? Any ideas? And we have kept that under the heading of non-current assets. We are talking about assets here. We have a non-current asset heading, and then we have the current asset heading. Within non-current asset, we have got something called capital work in progress. What could that possibly be?
Any planned and new expansion plans which are carried out?
If
Right,
something is not completed till the data shown in balance sheet, like we are planning
As
to
of-
buy something.
Right. So maybe we are making a factory structure, or maybe we are coming up with a office building. So we are working on it, and till 31st March 2021, we were not able to finish up with the same. And thus it is called a work in progress, and we give some monetary value to it. And that is what we actually mean by a capital work in progress. Some asset which is in the process of being ready or being acquired, that is capital work in progress. Very well said. Next is investment property. So investment property, what is investment property? Any ideas?
Properties which are acquired, like land, building, and which are rented out.
Right. So we are talking about L&T here, and L&T is basically a construction major, I would say. It's into building of roads, highways, ports, airports, and so on. So it can have several properties where it would have invested, which it would be developing in future, and that could be the possible plan. So that is what investment property is for L&T. Goodwill, we all understand it is. We had this intangible word coming up several times here. So it is an example of an intangible asset. It is something which you really cannot see, right? It is something which you really cannot see, touch, and feel. So goodwill is something which is notional. Am I clear? Yes, no?
Yes, sir.
Right. There is a separate section about goodwill valuation, but that's not here. It's a different detailed session. We'll talk some other time, maybe not now. Then there are other intangible assets. We have understood what intangible assets are. Intangible assets under development. So possibly you are working on some patent, some research is going on. So that would be an intangible asset under development. Right of use assets. Right of use assets. Anybody, any examples here? What do we mean by right of use assets?
Leased assets like mines or.
Very good, very good, very good. Leased assets like mines, yes. So anything for which you do not really have the ownership, full ownership with you. So leased properties or leased assets are very good examples of. You have got the right to use it, but you really aren't the owner of the same. So these are right of use assets. Then you have got financial assets, and then there are subcategories within the same. You have investments in joint ventures and associates. So there would be financial assets. You have possibly bought their shares or invested in debentures or bought some financial security, basically. Then there would be other investments in other companies. So L&T investing in Tata, say for example, or Reliance, say for example, or some FD, for example. Loans towards financing activities. So you have given loans to some other businesses, some other projects, other loans, other financial assets. All these are financial assets. The question that we had was deferred tax assets. Yes, no? I believe Mr. Ramesh, you had this question.
Yes, sir. Yes, sir. Yes, sir.
Right. So there is a possibility that the company actually ended up paying more than what was actually required. So you say, for example, had a 5 crore rupee tax obligation, but because there is a system of advanced tax payments in companies, you are required to pay in advance, forecasting what could possibly be the future tax requirement, depending upon your existing sales and the trend. So you make advanced tax payments for a company. The advanced tax payments are compulsory. So you make some advanced tax payments, and that is what we call as deferred tax assets when you actually find out that these are not really to the extent that was expected. So you had paid, say for example, I said for example 5,000 crores you paid as an advance tax, but you actually ended up the obligation actually worked out to be, say for example 4,000 crores of advance tax. So 1,000 crore would basically be figuring as deferred tax assets, which would be possibly adjusted in future, or you would be paid back. Clear?
Yes, sir. Yes, sir.
Right. Thank you. Then there could be other non-current assets which are there. Within the current assets, we have, if you have any question regarding any item, we are discussing one by one each of these items. And if you have any question, you are simply requested to please raise the same. Inventories is all of us, and we understand inventories. Inventories could be in three possible forms. One is the basic raw material structure. Then you have the work in progress, so working but not finished. And finally the finished goods form, which are yet to be handed over or sold out. So they are the three forms of inventory that we have. Then again, we have got financial assets, and as I said, financial assets could be investments, trade receivables, cash and cash equivalents, other bank balances, loans towards financing activities, other loans and other financial assets. So these are very much there in the non-current asset category also, yes or no? They are here, and most of them are here as well, right?
Yes, sir.
Hello. So you have other financial assets, other loans, loan towards financing activities. Then you have got investments. So why are these here and there also? Because these are typically of a longer term nature. They are not going to mature in this very year, and all these are going to mature in this very year. And that is why they are in the category of current assets, and these are in the category of non-current assets. Clear?
Yes, sir.
Right. Okay, let's go on to the equities and the liability side. So first, equities. So equity share capital. Then we have got other equity. Let's talk about what could possibly be in other equity. Any ideas, anybody? What is other equity?
It's preferential capital. It can be.
Preferential capital. Preference is not exactly equity, so no.
Yeah, share premium amount.
Share premium will not go in capital. It will be a reserve. Securities premium account karke will have a separate reserve account. Other equity is basically most companies, most good reputed companies give ESOPs, right? Employee stock option plans. Yes, no?
Yes, sir.
Yes, sir. Yes, sir.
Right. They typically qualify as other equity here. Then we have equity attributable to owners of the company and non-controlling interest. I would really like all those say experts out there who can help the whole class here understand non-controlling interests. We have this question coming up several times. We had this Capital IQ company. It's a Stand Poor company which came into our campus for regular recruitment processes, and they would ask our students minority interest. What do you mean by minority interest? Both are the same. Non-controlling interest and minority interest are the same. Can anybody explain what are non-controlling interests? Anybody, any ideas? Okay. So do we want to understand non-controlling interest, or should we move ahead?
Yes, sir. Yes, sir. We want to understand, sir.
Okay. As we said, we are working on the consolidated balance sheet. So basically, this balance sheet talks about the subsidiary companies as well, right? Yes or no?
Yes, sir.
Yes, sir.
Yes, it is talking about the subsidiaries as well. So when you set up these subsidiaries, it's not that almost always you have 100% stake on stake of the subsidiary. It might so happen that you have a 70-30 kind of a stake, wherein 30% is with somebody else and 70% is with you. So this non-controlling interest represents that 30% of somebody else's stake. But because the company is yours, it is in this particular financial statement also. Are you getting me? Yes, no?
Yes, sir.
So they don't really have any control on your business. Somebody who is a promoter of a subsidiary company cannot have a influence on the board of directors of the parent company. That is where the difference lies. Non-controlling interests are accounted for, but then they don't have any voting rights. These pertain to those shareholders who are having the other part, the smaller part in the subsidiary companies. Have you got it? Yes or no?
Yes, sir.
Okay. If you have got it, my question now is, will we have non-controlling interest as an item in the standalone balance sheet? Will we have non-controlling interest as an item in the standalone balance sheet?
I think we should not, because the standalone does not contain the subsidiaries.
Exactly. Thank you, Hanish. Thank you. You are absolutely right. Standalone balance sheets do not talk about subsidiaries, and therefore they will not have this item featuring in there. Great. Then we have got liabilities, and within that we have got non-current liabilities, meaning long-term liabilities. So we have got financial liability like borrowings, lease liability, other financial liabilities. Then we have several provisions, as was said, we need to have provision for an asset to be replaced in future, or maybe we need to repay a debenture in future. All those would be categorized under the head provisions. We have got deferred tax liabilities, which is absolutely the opposite of the deferred tax assets. And then we have got other non-current liabilities.
So there is one small query.
Yes, Anish.
How can one company have deferred tax liability as well as deferred tax asset?
They would be on different grounds. For different kinds of transactions, they would be there.
Okay.
So say for a company like L&T, it could have several simultaneous running projects, and on some projects they have a tax deferred tax asset. On other projects they might have a deferred tax liability.
Okay, got it. Thank you.
Okay, let's proceed. Current liabilities, we have got financial liabilities, again pretty much the same. Borrowings here, borrowings there. Current maturities of long-term borrowings. So current maturities of long-term borrowings are specifically those which in the previous year would be sitting here in the non-current category, but this year, because they are going to mature, they are in the current liability category. Lease liabilities, short-term trade payables are definitely short-term payments which are to be met. They are subcategorizing is because the government of India mandates them to report the MSMEs support that they are doing. So what kind of business they are doing with MSMEs, and what kind of payments are due and being made there. So that's here. Other financial liabilities, then other current liabilities, short-term provisions, current tax liabilities, which are to be paid in the near future. They are here. Is this clear, everybody? Yes, no?
Yes, sir.
Right. So this was pretty much the balance sheet. As I said, there are contingent liabilities which are not accounted for. So balance sheet, this double line indicates that the balance sheet is closed for the asset, equity and liability side, and you will find that this figure very much matches this figure. So there was again a question in the last session. Why is it called the balance sheet? It's called the balance sheet because all the balances are transferred and not because these numbers match. Okay, let's proceed. This is a very long statement, the consolidated statement of profit and loss, and I guess there would be sessions further, wherein you will be analyzing it more. So I have given it because I will be using this in my cash flow session that I have tomorrow with all of us. So we'll try and understand the profit loss statement along with the cash flow statement in the session tomorrow. Okay? Yes, no?
Sir, one question.
Yes, miss.
How will compare balance sheet of 2 years? Like in this site, L&T balance sheet we have 2020 and 2021. So what are the major figures in the balance sheet which we can identify the business is growing or not?
Okay, fine. So you are giving me a context. You want to basically identify whether the business is growing or not.
Yes, sir.
Right. That is a very good starting question to have. Now I want you to understand what do we exactly mean by growth?
Growth in terms of profit or performance of the company.
Right.
So if suppose I want
So
to invest some amount in L&T, so how can I understand that it is the perfect time to invest or not?
Now, these are two different questions here. First question was about whether the company is growing or not. And when I probed further, you said growth is in terms of profits. So that is a different question. Okay. Now your second question is about which is a good time to invest. That is a different question because that has got to deal with the stock price. So looking at the balance sheet, you cannot have an idea about the stock price. So let's leave that question apart. When you are looking at the financial statements and you want to know whether the company is growing or not, the figure to be looked at is net profit after tax.
Okay, sir.
Okay, so you have this in the income statement here. Net profit after tax. This is the column. So last year the company had 10,800 crores of profit, almost 10,900 crores of profit. This time around it has 12,900 crores of profit. 2,000 crores ka extra profit the company has been able to earn in this year alone. So that is a rise of almost 20%, from the previous year's profit figures. So yes, the company is growing. The profit is growing year on year, but almost 20%. So that question is answered. But one single year ka growth is not really comprehensive enough to be able to make conclusions. You need to look at other figures. You need to look at other companies, what they have done in the given year. You need to consider the economic background, given that these 2 years, the previous year, 2020, was very, very difficult because the COVID and lockdown was far severe than this year's COVID and associated lockdowns. So possibly it has got a natural benefit there because of the environment easing up. But you need to compare, look at other companies also in the same space. How are they doing? How are they growing? And look at the long-term trend as well for the same company also. Then you can actually make a more meaningful interpretation of growth, whether the company is growing or not. Any other parameter of growth, anybody else? Varsha ma'am has given us a wonderful frame here that profit growth is what she means by growth. Any other growth parameter? Can we have any other growth?
In terms of increase in the assets,
Increase in the total assets, yes, even that can be possible, but then it is not as good as profits, because profits is something which is more meaningful, more substantial. Assets can have several other elements which not really give you the right kind of information, right? So if you're looking at total assets, this is what you have. This is around 3,08,000 crores of total asset in the previous year and 3,11,000 crores of asset in the current year. But as I said, this is a crude information and you cannot really make a lot of meaning out here. If you can look at simply the total of current assets, that will be far more meaningful. So if you can add up these figures here. So if I can Can you see my Excel sheet? If that is visible? Is it visible? Is the Excel sheet visible?
The PDF is currently visible.
The PDF is visible. Okay, just a minute.
Sir, there is a term pledge shares.
Pledge shares. I'll come to it. Just let me finish this. So I was talking about asset side, and if you can simply total up this, you find that it is roughly about 44,000 crores of long-term assets here. No, you can add this as well. Yeah. This is around 1,16,000 crores in the current year, and this is 1,25,000 crores. So long-term assets have actually gone down here. Yes or no?
Yes, sir.
Right. So you need to analyze this further, and as I said, this would be a very crude measure, but it is some measure, for that is for sure, but it's a crude measure. Profits are a far more significant say storyteller for how the company is growing. Okay, we had something like pledge shares, right? Yes, no?
Yes, sir.
What was the question, ma'am? If you can complete that. Hello?
Yes, sir.
There was a question about pledge shares.
Yes, sir. What exactly it means? It is also shown in balance sheet, or we can identify that company has some pledge share, or we have to go through the entire financial statement and all.
No. You need not go to the entire financial statement. If there are something, because simple, the word accounting is simple if you understand the words, right? Pledge shares are shares which are pledged with somebody. And why would the company pledge them? Because they want to raise some funds, and till that time they are not able to give any other good collateral, so they are giving their shares as a collateral. So that is the meaning of pledge shares. And where do we find it? So once again, you go to your just a minute.
Sir, debentures
Annual
and pledge
report.
shares.
I'll come to it. Just a minute. So this is your balance sheet, and this is the equity side. You see your equity is detailed under notes number 20 and 21, right?
Yes, sir.
So when you go ahead and do some research there in the notes, you will find whether any part of the equity is pledged or not. That will be clearly specified there. You are saying debenture and pledge shares?
Yes, sir. Debenture is some around is equal to pledge, like we give some shares to
No.
credit. Yes, sir.
I didn't follow your question completely. Debenture is something what?
Sir, there is debentures and pledge shares are equivalent, or both are different?
No, both are very different. Debenture is something, it is like a fixed deposit for you to understand. So you normally go and buy a fixed deposit from a bank. If a company does a similar kind of a thing, so it's a piece of a paper, you may say, which is named as a debenture, and on account of that, the company undertakes to give you a certain amount of interest for a certain period of time. And say if you have 10 debentures, each debenture of 100 rupees, having a 10% rate of interest, so your investment is 10 into 100, 1,000 rupees, and the company will pay you 10% on your 1,000 for the next 10 years every year. That is a debenture, simple. So it's basically a fixed interest bearing instrument, I should say, fixed interest bearing instrument, whereas a pledge share is a simple collateral against which you have raised funds. So by virtue of having pledge shares, it's not that the financing entity to which the pledge share is given gets the voting rights of the company. That is not what happens. That is not what happens. It's a simple collateral. That's it.
Okay, sir. Okay, thank you, sir.
Yeah. Any other questions here? Ethel ma'am, can we write it off here? If there are more questions, I will be happy to take them. Can I stop sharing now? Ethel ma'am, are you there? Just a minute.
Sir, meanwhile, can I have a question?
Yes, please go ahead.
Sir, what is the meaning of discretionary accruals and discretionary incomes? Expenditure?
Discretionary accruals and discretionary expenditure. Discretionary is, how do you explain discretionary? Say, for example, in your household, you make some discretionary expenditure. So most expenditures are planned. So say, for example, you need to pay for your child's education fees. You need to buy the grocery, which is a routine in your monthly expenditure. You need to pay your home rent, your electricity bill, water bill, and the like. So these are compulsory expenditures which are to be met. And then there are some things which are, say, discretionary, as in, say, you went out to buy groceries, but you had pani puri, say, for example, or you ate at a fast food joint, say, for example. So all these are discretionary spends that you do. Similar natured expenses which are there when they are done by the companies, that would be classified as a discretionary expenditure. Are you getting my point?
Yes, sir. Yes, sir. Yes, sir.
Okay. I'm happy to take your questions if they are, otherwise we'll call it a day.
Yes, participants, do you have any questions? Barsha ma'am, I would request to please mute your mic. Anyone has any difficulties or any queries? The forum is open.
Thank you, Shrutika ma'am.
Okay, so since there are no questions, we can call it today. Thank you so much, Pranay sir, for explaining the accounting terminologies in such a simplified manner. I mean, JBV, whenever non-finance people hear the word finance, they are like, it's not my cup of tea. But the way you have explained the concept is really appreciable, and thank you so much.
Thank you. It was nice talking to all of you. Thank you.
And Pranay sir will be joining us tomorrow also in the second session. So see you tomorrow again, Pranay sir.
Sure. Bye-bye.
Bye. Participants, the link is already shared for the feedback form. Please fill up it. The attendance and the feedback form, both the links are already shared. I'm resharing both the links again for your ready reference. Participants, thank you so much for being with us for this entire day. Tomorrow, we will be meeting at 10:15 sharp. We'll have our first session by Dr. Sujit Maitre sharp at 10:15. So see you tomorrow. Bye-bye. Take care. I hope the participants have filled the attendance form. Shall I end the meeting? Someone can please answer me. Shall I end the meeting?
Yes, ma'am, sure. We have done.
Thank you so much, ma'am.